Okay, my name's Calista Cheung, and I manage the research and analytics team here at the Reserve Bank of New Zealand. You can probably tell I'm not a New Zealander. I'm actually from Canada, recent transplant here. And I have the pleasure and honor of moderating this next panel session, which is on the topic of how monetary policy should be conducted in a world of increasing supply shocks. Now, the context for this conversation we'll be having is the premise that we've been hearing about repeatedly over the last 2 days, that we may be in a world now of increasing supply shocks. They may be, a world where supply shocks are more persistent, more frequent, and larger over the coming years due to factors like geopolitical tensions, trade tariffs, reshoring, climate change. And at the same time, things like population aging, deglobalization may be making the supply side of the economy less or more inelastic. This is something I think Lagarde mentioned in a speech last year, and that would magnify the impact of these shocks on inflation. And it's been argued that these developments may force central banks to respond more aggressively to supply shocks, to avoid second-round effects and de-anchoring of inflation expectations. So that's the context for our conversation today. We have 4 distinguished panelists joining us today. They all bring a wealth of international experiences from central banks across 4 central banks from small open economies. So I'll just start by introducing each of them. On my left is Paul Conway, our very own chief economist at the Reserve Bank of New Zealand. Paul previously had been directing the economic and research at the Productivity Commission of New Zealand. He also brings experience from the OECD and the World Bank. Next to Paul is Sarah Hunter, who is the chief economist and assistant governor at the Reserve Bank of Australia. Sarah also brings experience previously as the head of macro at the Commonwealth Treasury and as chief economist at Oxford Economics. Next to Sarah is Ole Christian, or OC, Bech-Moen, who's the executive director of monetary policy at the Norges Bank, the Central Bank of Norway. He also brings previous experience as the chief investment officer at the Norges Bank Investment Management Fund. And on the right is Jing Yang, who is managing director of economic and financial research at the Bank of Canada. Jing also brings a wealth of experience from the BIS, Bank of England, and the ECB. And so my first question to set the scene for this conversation is, to sort of frame your opening remarks. I'll ask each of you to comment on the following question. So the conventional central bank response to supply shocks has been to look through them. Do you think the recent experience of high inflation has changed how aggressively you think monetary policy should respond to supply shocks? What factors will you be focusing on to decide the appropriate response? And more generally, how do structural supply side issues affect your monetary policy strategy? So why don't we start with Jing?
Start with me. Thank you very much. Thanks for the invitation. This has been a fascinating conference. I learned so much from every presentation. There's no better way to mark the 35 years of inflation targeting than being at RBNZ. So instead of give a long opening remark, I thought, looking back, I want to ask 3 questions. So first one is, should monetary policy response to a supply shock depend on the characteristics of the supply shock? For that, I mean when the shock is 3P: persistent, pronounced, and pervasive. So this is the persistency, size, and breadth of the shock. I think that's the key what we learned from COVID. And despite the fact we had a lot of supply shock in the past, but COVID shock really stands out being a PPP type of supply shock. I think that's one thing worthwhile thinking about. Second point I want to make is that while a lot of research since COVID have been focusing on business cycle frequency type of shocks, we should not lose sight of those huge structure shifts that affecting all of our economies, which I call 4 Ds: deglobalization, decarbonization, demographic, and digitalization. So all those 4 Ds are gonna affect economy in a profound way. And will affect all our star variables. We talked a lot about the star yesterday. They will affect those trends. Y star, R star, and U star, sometimes even the pi star. We all know monetary policy cannot affect steady state. So when those structural changes bring an economy from one steady state to another, monetary policy cannot change the steady state where we're heading for. But what is the role for monetary policy? What should monetary policy do during the transition? And later, if I have a chance, I may pick up one trade tariff as example to talk a little bit more about deglobalization. So last question is, this one's interesting. It's about the symmetry. Whether or not monetary policy responds to a supply shock, to a positive and negative supply shock in a symmetrical way. The reason I'm asking this question is because this morning, Professor Men's presentation, she asked a question about good luck versus good policy. Think about it. In the past 30 years, we could imagine what we have experienced is a series of positive supply shock. With the integration of China into global supply chain, into the trade system, we all benefited by having a lower inflation, a higher growth. And that tailwind will become a headwind when we're moving ahead, going into a deglobalization or trade fragmentation world. So what we had during the good times is that we had a goods inflation running persistently below 2%, sometimes even close to 0. And what do we do as a monetary policy maker? We accommodated. We accommodated by running service inflation above 2% persistently. Now, when that trend reverses, when we are no longer in the world trading goods inflation could be so low, are we ready to depress service sector inflation to be below target to deliver average inflation at 2%? So that's another question I think we should think about. Thank you.
OC, would you like to go next?
Yes, thank you. So let me start by saying that I completely disagree with my colleague, Øystein Røsland. This is nothing like the Emirates. This is like Old Trafford. I'm a United supporter and I feel at home here, exactly as I do at Old Trafford. I'm not going to answer the excellent questions that you raised, but I'm going to focus on some lessons learned, I guess, from the recent experience for us in the Central Bank of Norway. I think we haven't done anything, substantially with the monetary strategy, like top level. So we're going to treat supply shocks differently from demand shocks. Basically be less aggressive on supply shocks by extending the time period. And we're going to think about how long-lasting that supply shock is in determining how much we should respond. That was true prior to this event, and it's true now. So what has changed? I think we will be a lot better prepared if this happens again. We will simply be able to give better analytical support for the decision makers to actually follow their strategy. So let me mention a few things I think we will be slightly better at least. We will quicker be able to think in terms of demand and supply and try to decompose it. We will be aware of that the combination of supply side shocks and expansionary economic policies, both abroad and at home, can have substantial inflationary impulses. We kind of missed that a bit. And I think we didn't follow international impulses closely enough. We're better positioned now. We are now aware of, to a larger extent, that there are non-linearities out there. We will, of course, seek to identify them quicker next time around. I think that is quite important, but I think now the standard will be if you see a big shock, you will treat the dynamics of your inflation forecast differently now than previously, to mention one. So demand versus supply, the international focus, non-linearities. And I think we're going to learn from two risks that have been concern for us over this period. One is the risk that inflation will not come down, perhaps through elevated inflation expectations. I think we've learned that the work that has been done by previous governors and establishing that credibility, that has paid off really well. So we want to keep that also for the next time around. And this is perhaps a bit Norwegian specific, but we were concerned about what would happen with households when we hiked interest rates from 0 to 4.5. So households in Norway are massively indebted in a cross-country comparison, highest debt in the world, roughly. And they all have floating rates on their mortgages. And then I mean super floating. So it's a 6 to 8 weeks notice from we do something to their feel it on their mortgages. So that cash flow effect we thought could be massive. But households we've been surprised, they have been able / willing to smooth consumption a lot. So basically we have been surprised. Inflation has come down quicker than we expected. The real economy has held up better than we expected. I think this will form our thinking next time around as well. Let me end with just a few words on communication, because I think we're in better position now than we were, and I think we will be able to at least slightly better explain next time around why it's the right thing to do to increase rates while real wages are falling. That has been really challenging to get across that message. Now we have done a bit of a heavy lifting, and of course people have experienced it as well, so maybe it's easier to explain next time around. Thank you.
Thank you. Sarah, would you like to go next?
I'll add my thanks to Jazz. This has been a fascinating 2 days. The papers have been truly excellent and really thought-stimulating and provoking. And so thank you for everyone that's presented and that's contributed to the discussion. So I guess I was just listening to Jan and Osi's comments and thinking, gosh, Australia does sound like these countries. We actually have a little bit of a running joke internally that you can take the Norway policy statement and ours, and you could substitute the country names. It's remarkable how some of the outcomes are, and we have the same thing with variable rate mortgages too. The straight near instant pass-through for the majority of mortgage holders in Australia, so we should talk about that offline. But yeah, when I'm thinking about supply shocks, I guess I want to pull on a couple of threads that Jan and Osi have already mentioned, and two in particular. One, What do we mean by supply shock? It's a bit of a bucket, a catch-all, and I think actually it's worth unpacking it a bit. And two, in the spirit of all being small open economies, I absolutely agree, global versus local really matters. And maybe I'll start with the second and then come back to the first. So global versus local, I really think it's actually quite important whether or not you're facing a shock that others are facing into, or if your shock is, for whatever reason, somewhat unique to your economy. So, I mean, COVID's a good example where it was clearly a global shock. And if I think about the responses that we saw across economies, one thing that's quite interesting is that the fiscal responses were quite different. If I take a really broad bucket of countries, from substantial to not very much in some emerging markets, for various reasons didn't have the space to do anything. Pretty much everyone had to tighten monetary policy though, or they loosened monetary policy at the start and then they had to tighten as we came out of the other side. So that tells me that global really, really matters. And you have to consider that, and you're not an island. So if we're talking about shocks that are coming through that are global, then probably, to answer your question, monetary policy's got a role to play to counteract that. To come back to my first question, though, what is a supply shock? And what do I mean when I say it's a bit of a bucket? I think we can all imagine demand shocks. They're fairly straightforward. Households get a bit more confident, they spend some money, maybe there's a change in fiscal settings, something along those lines. Supply shocks, it strikes me, when we say that, we actually mean a few different things. It can be from supply fundamentals, aging population, and what that means for labour supply, or perhaps productivity, lots of discussion around artificial intelligence at the moment, things like that. But it also strikes me that it includes what I perhaps prefer to think of as relative demand shifts, and that inducing changes in the composition of supply. I think COVID is quite a good example of how these two can come together as well. So we clearly had a supply shock in that we had a pandemic, which meant that we were shutting down parts of the economy. We were closing factories and what have you, and that then limited supply. Yes, so a supply shock. But we also clearly had a substantial shift in the composition of demand, partly forced, partly we wanted to, and because of the closing of some parts of the economy, we then diverted demand elsewhere. I think this will matter going forward, because if I think about, say, climate transition, even things like artificial intelligence and things like that, it strikes me that they're likely to shift the composition of demand, and that will then trigger a change in supply. If I use Australia as an example and climate, if the world is moving away from consuming coal, that's a demand shift. It's a choice that's being made by a number of countries around the world. For Australia, that could potentially, probably will, actually implement and result in a change in the supply structure of the economy. So I think that really matters, and how we think about what the trigger for and the type of supply shock that we're facing will mean that we have to make different decisions about monetary policy settings. And just finally, to finish, my sort of third area that I think is quite important and we're going to have to think really hard about, and it comes back a little bit to what, Cheung, you were saying at the start around the star variables and how they might be moving. I think the time horizon for this stuff is really important. We've always had structural change running through our economies. Today does not look like the 1990, which didn't look like 1950, which didn't look like 1900. I'm going back before anything like monetary policy existed in its current form. But supply structures have been shifting over time, and that's not new. I think what potentially is new for some of what we're going to talk about today is the speed of the transition, or the speed of what we want to achieve in terms of the transition. I think that might have some implications that we haven't fully explored yet.
Thanks, Sarah. I might just follow up with one question, because among all the people on the stage here, your central bank has a dual mandate, and I was just wondering if you think that makes a difference in how the RBA would respond to supply shocks.
Yeah, it's a good question. I think Professor Bernanke's comments yesterday that even if it's not written in your mandate, you have at least an eye or a mind to being concerned about real economy effects. I have a lot of sympathy with that view. I think that's true. Or to put it in econometric type parlance, if you estimate the Taylor rule across all the countries in the world that have an inflation targeting regime, I don't think you'd find a zero coefficient on the output cap. So I do think it matters. I think where, though, you can say, is it a product of having a dual mandate, or is it more a revelation of preferences? I think you can have some control, not complete control, because you've got to keep inflation expectations anchored, and that really matters. But you can have some control about the speed of returning inflation to target after a shock or an event. Certainly, if I look at the Australian experience, so one thing we've definitely observed is probably on average it's taken Australia a bit longer to get back to target. In an underlying sense, we're not quite there yet on our official inflation data, getting close, not quite there yet. And we didn't, rates weren't raised as high as in other countries. That's a somewhat qualified statement, because obviously there's lots of reasons why you would or wouldn't raise rates. But I think as a general statement, it's an indication that the board had a sense of more tolerance for inflation staying above target for slightly longer. But really, slightly is the operative word there. I think in a broad sense, I don't think it makes too much difference.
Thanks. Paul.
Cool. Thanks, everybody. So a lot of sort of nuance and subtleties across all of those answers. And I think, in the broad scheme of things, it's obviously reasonable to go demand shock, supply shock. They're not the same thing. The inflation or the longer run inflation dynamics of a positive demand shock versus a negative supply shock, they might be kind of look the same in the short run, but they're going to play out through the labour market and through the rest of the economy in very different ways. So they are different. There's asymmetries there. But I think we can't be too sort of black and white around how we'll respond to a shock that has a very broad label, to cut to your point, called a supply shock. We've had a lot of presentations over the last couple of days. The context of the economy really matters. The Phillips curve sort of was flat for a bit and then it got steeper through COVID. So, that really matters. There's been talk about sort of non-linearities and how the inflation process plays out, although I was quite struck by Dr. Bernanke's point yesterday morning that when you put in sort of control variables into your Phillips curve, that tends to go away. To get back to your point, I think I love your PPP thing and the 4 Ds. I think you can't, you need to be able to assess each shock to the full extent that you can to sort of get the optimal response to it, which sort of takes us to Catherine's presentation this morning, digging into the microdata, digging into the inflation expectations data, really just to sort of get the contours of what a shock looks like. And sure, we can put it in a broad bucket of a supply or a demand shock, but you can't be too automatic in terms of what that means for your policy response. And just finally, I think a lot of the work that we've looked at over the last couple of days, and that's happening more generally in the monetary policy space, we are getting better at sort of identifying the nature of shocks in real time. But certainly over COVID, that was very challenging. So I really like all of the high frequency stuff that's going on in the macro world at the moment. I think it's revolutionary. I really like the stuff decomposing changes in inflation, the Bernanke-Blanchard stuff, sort of unpicking the nature of these shocks. But I think in real time, sitting around the Monetary Policy Committee table, that stuff is all extremely important and extremely relevant. But in the here and now, in a real-time sense, we cannot be too definitive about what sort of shock is that we're responding to. For me, it actually brings home the importance of what we've been kicking around the last couple of days. The research and to identify the dynamics in your 3 Ps is vitally important for us to get monetary policy response right.
Okay, thank you. I want to pick up on a point a few of you made, like Sarah was mentioning how these supply shocks, are they really just, relative price shifts? And, the pandemic did show that, demand shifts across sectors with different supply elasticities can become highly inflationary. And going forward, tariffs, climate change, the green transition, all of these are examples of potential adverse supply shocks, which could lead to major sectoral reallocations and large relative price shifts. And it's been argued that it may be desirable to accommodate the short-term inflationary effects of relative price adjustments, as it would facilitate the efficient reallocation of resources. So I was wondering what you think about that idea. For many of us, inflation's still hovering above 2%. Do you think we're yet in a space where we can kind of accommodate some of these short-term relative price shifts? So why don't we start the other way?
Okay, so it's a pretty pertinent question for us here in Aotearoa, New Zealand, because we have got inflation's been at 2.2% the last 6 months of last year. We've got it because of relative price shifts in energy and depreciation in the exchange rate. We've got it blipping back up to, 2.7%. I think in the third quarter of this year, reminiscent of what Catherine was laying out this morning for the United Kingdom. And just given where the economy is, given that there is very likely excess capacity in the economy, the judgment of the Monetary Policy Committee is that we're not in an environment where that blip up, that shift in relative prices is going to spill over into expectations. Expectations are very much glued to currently, which is another reason why the committee has got the confidence to look through that supply shock that relative price shift. And we see inflation going back down to our 2% target after that. And in fact, we were so confident we cut the OCR by 50 basis points a couple of weeks ago.
Short-run sort of shocks like that, or at the very shocks where it's entirely externally focused, so it's not like it's the fuel sector in New Zealand that's having to do some adjusting, it's coming in from outside. I think that those are more likely to be shocks you can look through. I agree, starting conditions are really critical too. Are you starting from a sort of balanced economy, negative output gap, positive output gap? All of these things matter, because then how does it sort of transmit through indirectly? Is it sort of, does it stop as just direct pass-through, or do you get indirect effects because it gets passed into supply chains and things? So I think those types of factors matter for that type of shock for sure. To maybe pull my earlier thread a little bit longer on some of these longer term shocks, or if you're looking at a shock where it is structural change within your economy, so the climate transition might be an example, or if you're subject to tariffs and that forces you to find new markets for your products, or perhaps pivot the type of products that you produce. You just haven't got the same markets that you had before. Those cases, I think, are a little bit trickier and harder. To maybe stick with the Australian example that I know best around the climate transition, you can see that if we do eventually move away from coal, we're going to probably have to put into other renewable energy type sectors. That's going to induce capital investment in those new sectors. That's a boost to aggregate demand. We're also potentially going to be facing some stranded assets in the old sector. So actually the capital stock changes from a potential output perspective. You've got something going into it, which is great, but maybe you've got an asset that's no longer useful to you, so that's going to take out. So those types of shocks, and you can maybe tell a similar story around shifting trade patterns and trade dispersion and how that might play out. Those types of shocks, it's not so clear to me even that monetary policy is necessarily pushing against. You might actually be able to help the transition. And that in any case, you probably need to do something about that if you're thinking about there's an aggregate demand shock here that's being induced by, or an activity shock that's being induced by this supply shift. Equally, I can imagine some of the transitions that we're talking about that perhaps the economy can do most of the heavy lifting on its own, and you just don't see it in inflation, so we don't need to do anything. For example, the ageing population, if that's shifting a composition in demand in the service sector, more into aged care, healthcare type services, things like that, less of education, maybe something along those lines. if that transition, if the labour market can do most of the heavy lifting, if it's an employment-intensive sector, then perhaps it happens anyway. That wages, between these sectors adjust, people move to where the jobs are, they move away from where the jobs aren't, and the transition happens that way. And from a monetary policy perspective, maybe we can sort of look at it and go, okay, that's all right, we don't need to get involved in that. So I'm not sure it's entirely obvious that you must respond every time. I think that's not true. And I think perhaps for some of these longer-term transition shocks, it's going to get a bit tricky, and we might have to face into how long are we willing to accept deviations, and what is the appropriate response in that world where you've got an aggregate demand shock coming through that is effectively the manifestation of a supply shock.
Can I just add, I agree completely with that, and I think it's a very interesting idea about shifts in demand having effects on the supply side of the economy. So all of a sudden, it's sort of bringing in more of the productivity literature, like how well does the economy adjust to this? How well do resources shift across industries and even across firms? And I think those types of dynamics will have impacts on what these shifts mean for inflation, and therefore the appropriate response for a central bank.
To Jan's stars.
Exactly.
So can I talk a little bit about, you said, should we be concerned looking through these types of shocks because inflation is still about 2%, but I think that doesn't really mean that much. The numbers itself, I mean, we're at 2.3, the headline now. I think you guys are all fairly close to your targets as well. It worries me more that we just had that experience with really high inflation, right? And if this kind of happens all the time or more frequently, how should we think about that? Because it's kind of that, if you think about the credibility as capital, you may kind of depreciate that a little bit each time around. And when are you going to build up that capital again? I mean, that is interesting. So just the fact that, it had happened for the fourth time, you may need to react differently than the first time around. Of course, you can monitor inflation expectation and so on and so forth to kind of get an idea. But that would be good to see more research on if may have been done already, but I'm not aware of it.
Maybe I just start by saying what I think of demand versus supply shock. Demand is very simple. Demand shock is a shock moves upward and inflation to the same direction. Supply shock is the reverse, move the two to the different direction. So which means there's a break of the divine coincidence. And in Canada right now, we are precisely see us in that situation because of the tariff war. Maybe worthwhile step back a little bit to let you know where we are. Abstract from the tariff is quite a big abstract. So abstract from tariff, the economy is almost at home. So inflation has been around, right now it's 1.9%. We have been around 2 since late last summer. And interest rate is at 3%. So which is already into the range of what we call the neutral rate, R star. And we have a very small excess supply. The upward gap is almost closed. What else? Inflation expectation. So throughout COVID, despite the fact inflation peaked at 8.1%, our medium-term and long-run inflation expectation has never moved, which is very, very good news for the credibility. What have moved was the 1 year ahead inflation expectation, but now even the 1 year ahead inflation expectation, as we all know, is more backward looking, follows the actual inflation. So now it's also came back around between 2.2-ish, 2.2, 2.5. So abstract from tariff, where economy is almost close to home. And now, just when I was here this week on Tuesday, U.S. imposed 25% tariff on non-energy Canadian imports and 10% on energy, and same thing for other major trade partners. This is very big impact for Canadian economy. Just to give you a sense, this would have both demand and the supply side effect. So look at the demand first. 75% of our export routed to the US, which accounted for almost 20% of GDP. So as you can see, a 25% broad-based tariff would have a huge impact on demand. And that will lead to lower export, lower investment, and a lot of job losses. On the supply side, when Canada also announced a counter tariff, the retaliatory tariff, although it's in a much more limited scope. This would have an impact on prices. 13% of our CPI basket is made of goods imported from United States. So when we impose counter tariff, this will have at least a one-off effect on the price level. In addition to that, depreciation of Canadian dollar, that will make all our imports more expensive. So clearly we will see those supply side effect. So with that, according to our simulation, we will see GDP will be 3% lower, and inflation will be above our 2% target. So we're precisely in that situation. We need to make a trade-off. Do you want to stabilize output or inflation, knowing you cannot do both at the same time? So when we think about those issues, think about policy responses, I think we do need a richer playbook for monetary policy. We need to look at many different monetary policy responses. To start with, the base case will be Taylor rule. Taylor rule estimated by the historical behaviors of policymakers, and say that would give you a policy path. But that's not all. We should go into, in those particular situations, as we listened to yesterday's presentation, Taylor rule on its own, it is agnostic about the source of the shock. So when we face a supply shock, we may want to deviate from Taylor rule. Then if you look into optimum monetary policy, Ramsey type of optimum monetary policy in a two-economy, open economy model, that will give you a path. That path would recommend you prioritize your output stabilization. So monetary policy should be more accommodative than what is suggested by Taylor rule. And we also run a number of other paths, for example, what I call optimize the Taylor rule based on certain loss function. And there you can specify explicitly your relative preference about output stabilizing versus inflation stabilizing. So with a balanced loss function, that policy path is also more accommodative than what the Taylor rule gave to you. And yesterday, I'm learning for every presentation. Yesterday, there was a paper about targeted Taylor rule. We can cross-check with that one. And I wouldn't be surprised that one also going to give you the similar type of recommendation, which is monetary policy should be less stringent than what is suggested by a pure Taylor rule. So all of those, I think, are very important ingredient to put forward in front of policymakers. But the question is, can we all know we should look over or look through the first round effect. But imagine we just come out of COVID. The memory of a high inflation or inflation surge was very, very fresh in people's mind. And can we afford? And how should we take that part into account? So for that, in-house we have a model very similar to Professor Catherine Mann explained today, with endogenous credibility built in, so which is you could have two type of backward-looking and forward-looking type of inflation expectation formation, and to see, and the share of the two type of agents will be totally endogenous. So this will give us a chance for inflation to be de-anchored. And when you run this model, we run our core model with this type of information formation, and you will get another policy path, which is taking into account the possibility of the anchoring inflation expectation. So I think those are the things exactly we're going through. Those are the type of exercises we're going through, and this is very important. The last point to make, and I'll stop there, is that trade war is very different from COVID. COVID is a cyclical shock. It's a business cycle frequency type of shock. When the lockdown ended, the economy bounced back very fast, back to the pre-COVID levels. I cannot say that for the trade war scenario. If the tariff would be long-lasting, and the trade war would put us in a completely different new steady state. The economy will be permanently on the lower growth path, so the Y star will be lower. It's very important for monetary policy makers to communicate with the public what monetary policy can and cannot do. Monetary policy cannot offset that lower R star. Any kind of effects come from that. What we can offset is the transition from one steady state to another steady state. We probably can react to the upward gap in that case, conditional inflation expectation well anchored. I think that's a very important information to convey to the public and for people to know, understand the limit of monetary policy.
Absolutely.
Yeah. So thank you all. I mean, it sounds, so what I'm hearing is, the nature of the shock really kind of matters a lot in how monetary policy will respond. So, Sarah, you mentioned some of these, maybe the more traditional slow moving types of structural changes that normally happen, they often just sort themselves out. It's maybe more some of the sudden, they happen suddenly and everyone's taken by surprise and things have to shift very quickly.
Or if it's you're just trying to do it quickly.
Yeah.
Climate transition, again, a good example. It took us 100 years to establish fossil fuel burning as a source for electricity. We're trying to move away from it in a matter of decades. Mm-hmm. It's quick in comparison. I think speed is important.
Yeah.
Yeah, and then, it's been mentioned a couple times or throughout the last day or two, whether it's a global shock versus a domestic shock really matters for how, the exchange rate's going to move. So I'd like just to, maybe discuss a bit more that exchange rate role. Traditionally, as small open economies, the exchange rate often helps us buffer against these shocks. What role do you see the exchange rate playing in helping us kind of navigate through these relative price shocks going forward? And Sarah, you mentioned a few times, so maybe we'll start with you.
I feel like it's been my question of the day, hasn't it? I've asked it a few times. So I think the sort of the traditional, or at least the historical experience, and keeping with Australia as the example, is that the exchange rate can be incredibly helpful. We've got a fully free floating exchange rate. We don't intervene. It's been the case for quite some time, and it has been very helpful through shocks that we've faced in over the last, say, 15 years or so. The one that the Australians in the room will know very well is the mining investment boom. China's sort of ramping up of their consumption of iron ore, production of steel in particular, very good for Australia. So we had a big boom in investment in iron ore and then later natural gas that sort of peaked in the early 2010s. The GFC was a bit of a disruption, but that aside, it sort of ramped up. And then came to an end. The boom came to an end, and that level of activity fell right back really sharply. It's an incredible chart. If you want to go and look at a big cyclical swing in the sector, go and have a look at mining investment in Australia. The exchange rate through that period was really very helpful for stabilising that through the economy. Through that ramp-up period, the Aussie dollar actually went through parity with the US dollar. Incredibly strong. That slowed down the non-mining economy quite considerably. If you lived in Sydney or in Melbourne on the East Coast, not really mining focused, felt pretty tough. I wasn't in Australia at the time, but people tell me it felt pretty tough in that part of the country, whereas Perth, centre of the mining industry, absolutely going great guns. And then it flipped. The exchange rate depreciated by sort of peak to trough, I think it was almost 40%, huge depreciation. And it just flipped. And so then Perth, I first went to Perth in 2017. It was like being in a ghost town. They were so excited to see a visitor. For sale signs everywhere, and the hotel were just, oh my goodness, somebody here that wants to stay with us, goodness me. And that's the point in time when Sydney, but Melbourne and Victoria in particular really picked up very strong growth. And through all of that, no recession. Monetary policy did some adjustment too. I don't want to say you can just rely on the exchange rate and walk away, but it really helped to smooth through that cycle. Now, I use that as an example and sort of tell the story a bit because that was quite a unique Australian experience. Other countries, other miners were clearly probably having a similar type of experience, Chile and copper and things, but most of the world economy did not have that experience through that period. Very different experience, obviously, coming out of the GFC and things. And so the exchange rate there for Australia was incredibly powerful as a stabilising factor. Now, to carry on all of my questions today so far, if you've got a shock that's relatively uniform across all countries, or most countries, if we're all facing into the same thing, it strikes me that that exchange rate response, at the very least, won't be as pronounced, and possibly even it goes the other way in some very extreme version where you're less exposed, other countries are more exposed, and so in a relative sense, you perhaps go the other way. So if it was an overall negative shock, but you're less badly impacted, maybe you appreciate even, who knows. I think that I highlight that because then in that world, perhaps it doesn't help you as much. And perhaps there's more of a role for monetary policy and conditions and times look different. So I do think that context really matters. When you can get a clean run at it, I think that it can be incredibly powerful and helpful, and that's a reason to let it do what it can. But I'm not sure that you can just rely on it. And not that we ever would. You're not going to sit back and just watch and wait. But I think it's something for us to be mindful of. And certainly when we're doing our research, and that was where all my questions were really going, was to just, I think we have to think about it in the context of how we do our analysis and how we give our advice to our respective policymakers, because they need to be aware of what this channel might or might not look like, even though we're never going to be able to put an exact number on it.
Can I add something to what you're saying? I fully agree with what you're saying, and we had the same experience in Norway, or similar experience in Norway, with the oil sector building up and then down, like your mining industry. So I think, when something fundamental happens that kind of requires some changes in relative prices, it's really nice to have the exchange rate that is not sticky, right? Other prices could have changed, but it takes time and has real effects. So I think it has kind of served us well in certain periods, the floating exchange rate. We're struggling a bit in communicating it, actually. So let me talk a little bit about that first. And we're not welcoming, so the NOK has weakened over the latest few years, the Norwegian krone. And we're not necessarily welcoming the weakening in itself, but it's more like if something changes fundamentally that indicates a weaker krone and then happens, then it's okay. The fundamental factor itself, like oil prices going down, not necessarily good for the Norwegian economy, but given that that is falling, something needs to change. The exchange rate is fine that changes. But then you have the volatility in the exchange rate itself. We've had a spike in volatility and it hasn't come down. I think that there are costs with that volatility. And over the latest couple of years, inflation up, so a global supply shock, if you think about it like that. And that may correlate with a risk premium shock on the Norwegian krone. So you get higher inflation imported for prices increasing abroad, but on top of that, you get a weakening krone and even higher imported inflation. So it doesn't help you all the time, right? And I think that is worthwhile thinking about. Are there ways of getting, the best you can get with the floating exchange rate, but also thinking about other ways of, at least dampening the negative effects of it.
Maybe sometimes policy has to work against it. Yeah, I agree. It's that global context, isn't it?
Yeah, just to add on to that one, I think when we get a demand shock, exchange rate works really well to support the economy. When you have the supply shocks, like what we're having now, during tariff war situation I just mentioned, the depreciation of the Canadian dollar would play two roles. Going to make your export more, support your export, make it more competitive, but at the same time, also make your import goods more expensive. So it would exaggerate that type of the trade-off. So that's could be tricky.
I guess that depends on whether you retaliate or not as well, those exchange rate dynamics. Like for New Zealand, I was kind of struck when I came to the Reserve Bank over that sort of post-COVID inflationary pressure period that our exchange rate it didn't move, even though there was so much going on. And I think that sort of reflected the fact that to a large extent it was a global shock that was sort of being offset across different countries. More recently, our currency has depreciated a little bit. The conversation around, or at the bank, is sort of what's the source of that? Getting to your point, is it a sort of portfolio shock? In which case there might be a case for a monetary policy response, or is it acting as a buffer to sort of offsetting different sort of shocks to the economy across our trading partners?
I just want to go back to a point you made earlier, OC. You mentioned at the beginning, you think, you're going forward with these supply shocks, you'd be better prepared, you think. So could you talk a bit more about the work your central bank's done to kind of help you better distinguish between demand and supply shocks, or recognize, when a shock's going to be persistent, or how you recognize when you're moving into a high inflation environment?
I can say a little bit about it, but I think, we haven't done really anything unique there. I think a lot of other central banks have done, even more on this than we have. So, of course, we have had the kind of the structural VAR approach, trying to decompose it into demand and supply, foreign and domestic, looking at the persistence of demand versus supply shocks. We've done that bit, but I think a lot of central banks have done it. We had some more theoretical work, regime switching type of thinking from backward-looking to forward-looking type of inflation expectation formation. I think we've seen that as well. Done a little bit of work on asking, using our regional network, our surveys, to tease out, whether the pricing formation is different this time around. I think that has been useful. Started doing some, work on data as well, but there's a lot of room for improvement on that part, using microdata. We have data, but it's a tough job working with microdata. So I acknowledge the people in the audience here working with that. So we have the data, but we haven't had the resources and time to do it properly yet. So we don't need a big supply shock exactly now. We need some more time to do the work.
So we're almost at the end. So I just want to sort of wrap up with a final question. And I know, OC, you have to leave right at 4:30, so maybe we'll start with you. But I'll ask all of you to respond with just a minute or two. What do you see as the big questions for further research going forward that central banks should be pursuing?
Well, I think we're going to see a lot of better answers on all good questions.
These questions.
Using microdata, as I mentioned. I think I think it's important not only to fight the last war, so we need to not go all the way just focus. I know this is a panel about supply side shocks, but other things can happen as well. What I would like to see is, how can we better navigate within the targeting inflation regime? I think we're doing kind of risk management considerations. I hear a lot about it, but I haven't really seen a really good framework for doing it properly. So more research on kind of how to do risk management. I would love to see that. And even though it is kind of working well, inflation targeting, I still think that we should seek an even better regime. So research on, the next thing. But history is pretty clear on that. It will be the Reserve Bank of New Zealand that figures it out.
I like inflation targeting.
And we'll just follow after a few years.
Jing, do you want to go next?
Well, in retrospect, I think one of the key lessons we learned during COVID is that our model failed. So I don't think our model is sufficiently good to address supply side issues, and we really need to develop that part out. At the Bank of Canada, we embarked on multi-year efforts to develop next generation models. We have already moved forward, advanced in a number of fronts, which would definitely help us for analyze demand versus supply shock. One is we have a fully fledged labor market right now in the DSG model with search friction. So that would be very helpful to address a lot of questions you see in Blanchard type of analysis when how do you quantify the tightness of labor market, and what is the pass-through of this wage and price spiral. And we also build out the whole intermediary goods sector. That is very helpful in the tariff scenario to be able to address the pass-through from the re-imported inflation from the United States going to your input cost, and to what extent the input cost will translate into prices. And we also made quite a bit of advancement on building up the whole production network based on input-output table. So that would help us to address supply chain disruptions, those type of questions. And also in terms of firm pricing, given what we have all experienced, many papers talked about this nonlinear Philip curve. So this model would allow at least that part of the firm pricing behavior will be state dependent. So we're moving ahead on that, and the shadow projection will go into very soon, the upcoming round. I cannot emphasize more that we need to be humble, because identify demand versus supply shock is always hard, and it is even harder in real time. We should not think we have a better model now, this model gonna beautifully deliver everything. Someone said, when we increase the circle of our knowledge, we expanded the circumference of our ignorance. So we have to be very, very mindful of that. Yeah. And I think going forward, I'd like to see more research done, both on, we're talking about the model development, but I'd like to see more research done by how to conduct monetary policy under uncertainty. Here, the range of uncertainties, I think, is some of the questions I already touched on.
Thank you. Sarah.
Well, a lot of commonalities with OC, Jan, and of course we've got our to-do list, really, courtesy of Renee and her review panelists. Thank you for it, and I hope now that you're a board member you'll start to see the fruits of all the work that we've done to address those. So I won't repeat sort of lots and lots of commonality, but maybe just 2 quick points. And I agree, humility is really, really crucial, as is curiosity. I love our subject. I love that we're still learning always. I hope I'm still learning when I finish up at the end of it all. I fully intend to be. And so in that vein, I'm really excited about how we can integrate the micro data learnings that we're doing so much in that space now. I mean, that data, those didn't exist when I was starting out as a student. I think it's incredible we have it now. So how can we integrate the learnings from that into our general equilibrium models? That's really hard. It opens up questions around, does distribution matter? How does it matter? Non-linearities, how on earth do you write GE models that have those types of things built into them? What is the actual, are there some of the fundamental structures in the GE models that we have to revisit, actually? I think that's pretty exciting. And so where we go with that as a profession, I think is fascinating. And uncertainty, I agree with completely, but also communication. I think we need to do more work, and I do think it is actually research into how we communicate with the general public so they understand what we're doing. We're all here because we're credible and we're legitimate, and we have to ensure that we continue to be so. And we have to represent and ultimately set policy to achieve the goals that society wants. We're here because we've been asked to do the job, but you've got to remain credible and legitimate in doing it. So some actual understanding of what it is what do people think inflation is. We have a research paper out just over a year ago where we'd done a bit of a survey and asked people. It was frightening how few people knew what inflation was. They just didn't understand it as a concept and other real basics that we all take for granted. So if that's where we're starting from, we've probably got quite a bit of work to do in that space, I think.
Thank you. And Paul, I know you will be speaking to this in your closing remarks. So if it's okay with you, we're going to wrap up because it is past 4:30 and I know OCS have catch a flight. So thank you very much, all of you, for very insightful comments. Thank you. And
Nice work. Thank you for coming, Thank you. We'll see you.
Conway to the stage to give closing remarks.
Thank you. I'm worried this is going to make a... Okay, so my job is to wrap up the conference, so we're very much on the home stretch. I know I'm the last speaker at the conference, which is always a tough gig. And I got to say, I'm full of gratitude, really, is what I'm mainly feeling. I still, I can't believe you all came. And you're all still here after a pretty grueling 48 hours of thinking. So thank you for that. We here, certainly in New Zealand, less so in Australia, and obviously less so in the US and Europe, but we're a small community, and we have a very important job to do. And that job, it's most likely becoming more difficult, at least relative to the great moderation. So thank you to everybody for your contributions over the last few days, or the last 2 days. By sharing our perspectives and by learning from each other, we really sharpen our ability to navigate an increasingly complex economic landscape. And I think the knowledge that we share, that we have been sharing, and also the connections that we make, that idea that we started, whanaungatanga, of coming together. I think we call it networking, as Ants told us in the opening, is really important, and ultimately it'll improve how we do monetary policy in our respective institutions. So my job is to reflect on some of the key themes from our discussion over the last few days, and then I'm going to end sort of with a call for more ongoing collaboration going forward. So I've got a few key themes. I think there's 6 of them in total. The first one is well, it seems, inflation targeting. It's 35 years old, but it's going strong. It remains fit for purpose, provided we continue to adapt and learn. As Dr. Bernanke told us, and Christian made the point in his opening remarks as well, inflation targeting, it has led to lower inflation, and it has improved economic stability over the last 35 years. The framework has also evolved in response to new challenges, and its resilience has been tested, not least of all by the unprecedented events and shocks of the last few years. Now, I heard 3 core principles for a strong monetary policy framework. First of all, transparency. As Dr. Bernanke said, it's not just about announcing a target. Our communications needs to be clear, and we need to talk about how we're going to achieve that target and why it matters that we achieve that target. And this, of course, it reduces uncertainty, it anchors inflation expectations, it aligns markets with policy settings, and it reinforces the public's trust in their central bank. So second broad theme, credibility. When people know that we are going to deliver achieve our mandates, inflation expectations remain stable. So that reduces economic volatility and ultimately makes our jobs easier. And also credibility is a foundation of independence, and as Renee pointed out, regular framework reviews help us maintain that credibility and ultimately our independence. Third broad feature, flexibility. So it's about striking the right balance between anchoring expectations but also being agile in how we respond to unexpected shocks. And again, I think clear, I love the emphasis on communication in the panel session, because I think being clear in our communications is critical here. It helps people understand that if economic conditions change, then policy will adjust accordingly. And Enrique, he highlighted that the effectiveness of inflation targeting, also depends on broader sort of macro context, institutional factors, the degree of financial openness, exchange rate stability, monetary policy independence, etc., etc. And keeping all of that front in mind in designing, and probably more to the point for everybody in this room, reviewing inflation targeting frameworks is going to help us navigate the uncertainties that clearly or undoubtedly lie ahead, not too far ahead in the case of Canada, by the sounds of it. But I think it's a given that shocks are increasing in frequency, as we discussed in the panel. Okay, the second broad theme that I think we've been talking about the last couple of days, alternative monetary policy tools and strategies, they remain in the toolbox. I think the pandemic clearly pushed many of us to use alternative monetary policy tools to stabilise markets and to stabilise our economies. And we need to understand the effectiveness and the trade-offs of using these tools so that we get future policy decisions right, especially in times of crisis. So we revisited LSAPs, large-scale asset purchases, our version of QE here in New Zealand, and did it deliver net benefits for New Zealanders? And the evidence that Carsten put up there, suggests that they did help support inflation and output with a similar fiscal outcomes to a scenario where LSAPs weren't used. And I'm going to talk about sort of pushing this a bit further towards the end of my remarks. I think we're also strengthening our understanding of assessing these tools or of how to assess which is the most appropriate tool to reach for in the face of real-time uncertainty. And again, the research presented today, it provides more transparency on the costs and benefits of alternative monetary policy tools, as a few people mentioned in the Q&A. And I think that gives us a more objective basis for assessing future central bank actions. Although I take Catherine's point, the benefits are in the past, the costs are current. It's a hard sell, absolutely. Okay, and in terms of strategy, a lovely presentation, lovely piece of work from Bruce, making the point that strong forward guidance can be viewed as a type of insurance, and the premium being too much stimulus if the downturn proves to be less persistent than originally anticipated. Okay, the third broad theme that I think that's kind of run through the discussion the last couple of days, the interaction between monetary and fiscal policy really matters. That was going to be what I said in terms of research that I think we need to sort of double down on and push forward. But in terms of what we've discussed, we came at it from two angles. First, we had Royce highlighting that the right mix of fiscal and monetary tools depends on the shock. So, for example, tight monetary policy alongside loose fiscal policy, it could leverage exchange rate effects to reduce inflation with less unemployment. And then we had the work that Naveed and James are doing, showing that contractionary monetary policy in New Zealand has been more effective during periods of fiscal tightening compared to when fiscal policy was more expansionary. And that's certainly the case during the pandemic here in New Zealand. So, monetary and fiscal policies were very powerful in combination in those early COVID years, especially when interest rates were near that lower bound. So here at the RBNZ, we are working with our friends and colleagues across the street at the New Zealand Treasury to explore, what does best practice look like in terms of monetary fiscal coordination. We're developing other models to better understand how these interactions shape macro stabilisation in New Zealand, and the research presented today, helps us strengthen these frameworks so that we're well prepared for the next crisis. I like the idea of a playbook for how to sort of think about these, the interaction between these tools. In a crisis point, I think it's a very different situation when it's sort of peacetime on the inflation front and the macro volatility front. Okay, the fourth broad theme, which we had a good kick around then over the last hour or so, supply shocks are becoming more prevalent, ready or not. So supply shocks may well be becoming more frequent, larger and more persistent, and that's a challenge if the COVID experience was anything to go by. So in New Zealand, labour markets were incredibly tight over that period. Supply shortages were dominant in driving persistent inflation over that period. Increasing relative prices for food and energy, they played a somewhat smaller role here and more temporary sort of persistence there compared to other countries, according to the Blanchard and Bernanke framework. We had a really good discussion about whether monetary policy should respond more aggressively to demand-driven inflation than to supply-driven inflation, with Christina's work suggesting that maybe a differential treatment is optimal. Of course, as we just talked about, it can be challenging to accurately identify and assess the impacts of supply shocks in real time. But, as we talked about, I think we're getting better at it, thanks to the research that many of you in the audience are doing. We're developing better inflation decomposition techniques. We're getting more granular in terms of our analysis. We're getting across broad data pools. And like everyone, by the sounds of it, I've loved all the micro data work that has been presented here over the last couple of days. I think that's almost revolutionary in terms of the macro insights that we can potentially derive from that micro level analysis. I think as these methods evolve, so too does our ability to respond to new shocks with greater speed and greater precision. And we continue to explore that at Te Pūtea Matua, the Reserve Bank of New Zealand. So just in that frame, we're developing models to better analyse foreign and domestic demand and supply shocks, sectorial interactions, global linkages, all the stuff that we've just talked about. And I think that work is going to be very useful for thinking about how shifts in trade, energy policies, international disruptions, how all of that affects the New Zealand economy and sort of percolates through our economy. Because I've got a very funny feeling that all that is going to be useful going forward. Fifth, we had a lot of discussion and a number of papers around the theme of economic behaviour that changes in response to economic conditions. And that sort of seems obvious, it sounds obvious, but I think as I said, we've had some great conversations about exactly what that looks like. How do economic conditions shape household and firm behaviour? And we had some lovely work from Gulnara and Callum, showing household expectations. They form their expectations differently. So inflation expectations tend to be backward-looking, wage expectations tend to be forward-looking, and one's sort of more a perception of a demand shock, the other's more a perception of a supply shock. Households see inflation as eroding purchasing power, but they view wage growth as a sign of economic strength. Now, that can be quite challenging from a comms perspective. It can be difficult trying to tell people that falling wage growth is actually a good thing. And Matthew highlighted how wage rigidities and other frictions, help explain why people really dislike inflation. As prices fall, as prices rise, people, they feel poorer until wages catch up. We also looked at it from a business perspective. Matthias finds, firms adjust prices more in response to demand shocks when inflation is high and financial uncertainty is low, and firm characteristics influence that. Our second keynote, amazing presentation from Catherine this morning, and she spoke about the importance of endogenous expectations formation and the sort of risks of rational inattention, in the context of greater economic volatility. She laid out the implications of this for a monetary policy strategy, sort of advocating more of an activist approach. Very interesting stuff. And I think, all of this, it's critical in assessing how policy choices impact price-setting behaviour. Households and businesses, they adapt their behaviours, their expectations based on economic conditions. And I would add there's plenty of good work, including within the Reserve Bank of New Zealand on this, showing that households become more inflation aware and businesses become more inclined to raise their prices during periods of high inflation. So, monetary policy, obviously, and we had a good conversation about structural change in the economy. Monetary policy needs to be responsive or stay responsive to an evolving economy and the changes that it's having on the relationships within the economy and within our models. So keep those up to date. I think getting back to some of the points covered yesterday, rules-based approaches. Yes, they provide us with useful guidance, but they're less effective when underlying economic relationships shift in the economy, as they undoubtedly do. Someone made the comment, COVID has changed the economy. What does that mean for our understanding of it? I think, it's really retaining flexibility, regularly assessing the assumptions that we're basing our policy actions on ensures that policy remains fit for purpose. All right, and lastly, we're getting there. Structural changes in productivity and demographics influence our star. We've had a lovely sort of conversation about the star variables. I really enjoyed that part of Dr. Bernanke's Q&A, which was amazing yesterday. So our star, it's a rough approximation of an abstract concept, but it's useful. And as a small open economy, we're well aware that global forces shape the neutral interest rate here. And again, Dr. Ben Wong, I should say, highlighted how global factors tend to dominate, although domestic drivers also play a meaningful role. And we also saw that work with Andrew and Trent. The work that they presented. So global trends have contributed to the decline in New Zealand's natural rate, but weak productivity growth has also played a part domestically. And of course, we've known for a long time that low interest rates stemming from a poor productivity performance are not a good thing. Also, demographics was part of that work. So strong population growth in our economy. It's put upward pressure on New Zealand's neutral interest rate. That's also an important part of the reason why New Zealand is a capital shallow economy. Investment in this economy is spread thinly across a fast expanding labour force, and that's one of the contributors to our weak productivity performance. So in a nutshell, that's what I've taken from the last couple of days. We've written a note on it, which you can find on the website. I think that's already gone up. But it's been wonderful, and we have tackled some of the most pressing policy challenges facing central bankers today. We've covered a lot of ground, what makes for a strong monetary policy framework, the merits of AMP tools, the interaction between fiscal and monetary policy, how to respond to larger and more persistent supply shocks, shifting economic relationships and structural change, how that shapes our economy and our reaction function. Now, I'm going to, much of this work that we've kicked around today, as Christian mentioned in his opening remarks, we did a review of monetary policy in the 5 years to the end of 2022. It was one of the first things I got stuck into when I arrived at the Reserve Bank, and it identified, a number of priorities in that review that for our research agenda so that we're better placed for shocks that are no doubt going to come. And I got to say, it's incredibly gratifying to see real, tangible progress in all of those research areas, both within the Reserve Bank, but also more broadly across the monetary policy research community. Of course, our work is never done. We will never be finished. Our economies continue to change. And ongoing research, it's always going to be central to getting policy right. I love the interaction or taking research insights and operationalising them in the policy space. I think that's something we're quite good at the Reserve Bank. I think we're less good at it in terms of other areas of regulation, certainly in the New Zealand economy. I'm convinced that our productivity performance would be better if the insights from a lot of research over the years was better incorporated into the policy-making process. I also want to acknowledge that we are among the first generation, the first cohort of researchers to analyse and learn lessons from the COVID-19 pandemic. I'm not going to call it a gift, but it certainly has kept our jobs interesting. But we won't be the last people to go through this data. People will be doing that for at least a century. And I think the perspectives and insights that we've shared here over the last couple of days, they're going to continue to evolve as new research sort of deepens our understanding. Looking ahead, I think, as we've seen, we face many of the same challenges. And there are huge benefits, said the guy with a small economics department and a small but highly efficient research team. There are massive benefits to ongoing collaboration. I think working together across central bankers, across researchers and policymakers, I think that makes us way better prepared to navigate a more uncertain world. Ma whiro, ma pango ki oti ai te mahi. So that means with the red and with the black, the work gets done. Working together, we are better. Now, finally, the one theme that's come through loud and clear in this room is that after 35 years of stabilising economies around the world, inflation targeting is still growing strong. And what an incredible legacy for the people, some of whom are in this room, looking at you, Arthur Grimes, that developed that framework in the first place. In fact, I would go so far as to say that flexible inflation targeting might just be the most well-being enhancing big idea to ever come out of Aotearoa, New Zealand. And I know that's a bold claim, especially when you put that alongside, we also invented jet boats, and we also invented electric fences. And we also split the atom. It was a New Zealander that split the atom, just for the avoidance of any doubt. But that is my contention. I think inflation targeting is perhaps our greatest contribution to global well-being. Now, to close, I just want to say thank you. I just want to say thank you to all our presenters for your thought-provoking contributions. I want to say thank you to all our participants for your engagement. We've had some wonderful Q&As. And lastly, it wouldn't have happened without just a heartfelt thank you to the RBNZ crew. I feel very proud of you guys. You've absolutely knocked it out of the park. It's been amazing. So thank you, Emma. Thank you, Ali. Thank you, Matt. Thank you, Calista. Thank you, Adam. Thank you, everybody that's been on the Steerco working away to make this thing happen. I think you've created such a valuable platform here for dialogue and learning. And lastly, Ruben, where's Where's Ruben? They were worried I was going to forget about Ruben. Ruben, stand up and, take a bow. Now, this guy, he knows how to organise a conference. And it's the first time that we've done it for 5 years, but we didn't miss a beat. It was truly incredible. He's wonderful at that, and much more besides. Amazing research economist and amazing communicator and educator. So thank you, Ruben. Feel free to take the weekend off. And just thank you to everybody that has been here. It's been a huge week for us at Te Pūtea Matua, the Reserve Bank. We lost a much-loved governor on the Wednesday, and we hosted an international conference on the Thursday and the Friday. I see a big glass of beautiful New Zealand wine in my near future. And one thing I've learnt from all of this is that the show must go on. So also a huge thank you to our acting governor, Christian Hawkesby, for his extremely eloquent opening to the conference, which he learned he was doing at about 2:30 the day prior. In Christian, we have a very safe and a very stable pair of hands at the top of Te Pūtea Matua, the Reserve Bank of New Zealand. Okay, so just thank you so much. We wish you all a safe and pleasant journey home. I've got a bit of housekeeping. There is a dinner that I think a bunch of us are going to. You can tell because you've got a little black dot on your lanyard thingy. There's going to be buses out the front to take us there. They're going to be there from about 5:15, and dinner, we're sitting down there at about 6 o'clock. Wonderful. Now, there's one last thing that we need to do. If I can get this to work. I think I need some help. Is there a keyboard or something? Here we go. So, we started the conference with a concert. As Dr. Bernanke said, it was mihi whakatau in terms of the local sort of view of it. And the idea was to sort of just get us into the space. And if the subsequent discussion has been anything to go by, it worked extremely well. So for our last act of the conference, this is a karakia. You can see the English translation on the right. We're actually all going to do it together. So if you could stand, and we will go through this together. And Reserve Bankers, loud and proud. Okay, the last thing we want to do is make it sound thin. All right, so 1, 2, 3, 4. Una hia, una hia. Una hia ki tu uru tapu niwi. Kia waita, kia mama, kia nakuku, te tamia, te wauru, I te ara kapa. Kia ora rā I rongo, whakamari ai, aiki ki ronga, wakakita, whana, tina, hui ai, tai ki ai. Thank you, everyone.